Well, here at home, the PSEi kicks off trading back above the 7,000 level after gaining substantially 3.6% on Wednesday. Joining us today for her take on the market, Sandra Araullo of ATR Asset Management. Sandra, good morning.
Good morning, Warren.
Yeah, so what about those gains yesterday, huh? Pretty eye-popping.
Yeah, it was. And we expect some momentum behind it in the next few days, considering the Fed policy meeting results overnight.
Yeah, let's talk about that. What does that mean for the PSE? What does that mean for the next BSP or the first BSP rate setting meeting that's happening later this month? And of course, we also have that inflation forecast that the BSP gave for January, 7.5 to 8.3%. That's still pretty high, and 8.3% will actually be a build or higher than the 14-year high hit in December. How do you take all of this?
So let's start with inflation. No? The next inflation print will be out in about a week. And it's not so much the absolute level that's important. It's the fact that we are seeing topping out on expected headline inflation. It's really what's driving policy decision across the globe, from the Fed to the BSP to the ECB. What happened overnight is that markets were, including ourselves actually, we were expecting the Fed to talk back or to push back against pretty strong markets. The Fed has been quite committed to this hiking path, to taming inflation, and strong markets don't work with that. So we expected more of a pushback from the Fed. We didn't see it happen. They did raise rates, which was expected, but we were expecting a little bit more pushback, which we didn't see. So now we expect markets to be kind of emboldened by that development, and those that are caught flat-footed to add more or to close some of these short positions.
Yeah, and the BSP actually, they were hedging their bets. Governor Medalla saying that they may raise rates by 25 to 50 basis points. So now it looks like they're probably just going to match with the 25. What's that going to do for investor sentiment?
We do think that it's going to be a 25 hike in the next meeting 2 weeks from now. It's more of, we're looking maybe more 6 months ahead or to the end of the year. They're likely going to raise another 50 basis points in total. What do they do after? Do they keep it there? Do they start cutting before the year ends? The views across the industry are quite varied.
Yes, that's
some
right.
of our peers do think that there will be some rate cuts taking place later in the year. We at ATRAM, we do think, we disagree. We think that it's more likely a hike and hold for quite some time, given the possibility for stickier inflation. So there's a lot of disagreement and a lot of uncertainty, certainly in the street.
Yeah, stickier inflation. People have been talking about inflation easing toward the end of the year. And again, as you mentioned, that's going to inform BSP policy decisions, right? But looking at what's going on, we've already seen increases in oil prices. And then we have yet to see the real impact of the reopening of China. And that's a huge consumer. So is that part of the reason why you expect inflation to remain sticky?
It offsets, no? So a lot of the supply chain bottlenecks are going to be a tailwind, or I said it's gonna help ease inflation. But on the demand side, you have China reopening, and that may be inflationary. But there's also the dynamic between slowing down in the global economy. And so it's kind of an offsetting situation as far, I mean, it's not just one driver pushing inflation direction higher. There's going to be a push and pull. But given how policy moves have been quite dramatic in 2022, overall, we do expect a reduction in some demand-driven inflation, particularly coming from the U.S. We will see easing in second-round effects of inflation locally, given the FX or the peso-dollar exchange rate situation, and locally we do need to get more support in terms of the reopening. We haven't really taken off from the slowdown we experienced through the pandemic, and tight monetary policy is not exactly what we need to support that. So I think we just need to take many other things into consideration and not just our own. That's why the BSP had to move when the Fed did.
So are you saying you were not satisfied with the growth in the economy last year? What, 7.6%? You think it could have been better?
No, we're certainly happy with that growth. It signals, or it's to be expected given the very low base and even the contraction. It's the sustainability aspect that we're concerned about. You don't want to restrict or to have a restrictive policy just when we're coming out of this flash in the pan recession due to the pandemic.
Yeah.
We need it to be supported so that we can really sustain the growth, and at a lower clip, but more sustainable over time.
Yeah, understood. But the problem there also is, there's 350 basis points in increases from last year. That's expected to have a lag, and we're already seeing, the repricing is going to happen this year. People are saying it's going to hit this year. That's why a lot of people were already expecting lower growth. But we have actually talked to some people in real estate, and they said, combined with the inflation for construction costs, we're looking at some difficulties again toward the end of the year when, everybody's already facing those higher interest rates.
Yes, that's why I think from an investment standpoint, the theme is really risk management. Risk management in the sense that there will be winners and losers, so to speak. There will be reasons why fixed income, for example, will be more attractive than equities, and we're seeing that now from a risk-adjusted return standpoint, meaning am I getting paid adequately for the amount of risk I'm taking? And on the equity side, it can go up. It was strong. It was up 3% in one day, but it can also go in the opposite direction. So that is really the main objective that we have. Manage it well, get our spots, or we don't expect to have all the right calls, but as long as you're sizing it correctly, then that's where the risk management works.
All right, so give us your calls. What's the strategy? We've had 1 month so far into 2023. What are your recommendations for your clients?
So it depends on the time frame. In the very near term, we are not fighting the markets. We are closing our underweight on Philippine equities at the below 7,000. We think that level has held pretty well. We don't think we're going to see the 6,800 anytime soon again. So, but more strategically, we like fixed income for the much higher nominal yields that we haven't seen in a long time. There is a lot of liquidity behind that, and with inflation peaking, we think there is, aside from the income that you're gonna get, the capital gains that is possible is also very attractive from an allocation perspective.
Yeah. Some of the news out or the disclosures out today, we have Robinsons Retail talking about record level income from 2022. You have their net income attributable to equity holders up 26.7% in 2022. But it goes back to your point of the sustainability of this. You mentioned that you feel that inflation is peaking. So is consumer a play at this point?
So I have to caveat that, no, it's peaking because the base effects are winding down. I think that the good top or headline numbers getting from corporates on earnings are really just confirmation that we're well past the pandemic experience, or at least the risks that we were contending with during the pandemic. We're out of that situation, but that's kind of backward looking, and that's already pretty much baked in market expectations, and it's really something else that's driving markets right now, particularly equity markets. Although that said, purely from a fair value standpoint, we do expect earnings of corporates to still be in the high teens this year. Last year, it was like in the 40% average, and certainly was front loaded than what we had expected. So we had to downgrade our earnings expectation target for this year, but it's still in the high teens. And on
base effects, of course, as well from those corporate earnings.
Correct.
Yeah.
But when you plot that against index targets, your main drivers ought to be earnings growth and valuation expectations. We're already factoring in a devaluation, meaning our price to earnings assumptions are already much lower than where they had been. So I think we're assuming about 15 times PE, and that still brings us to much higher levels than where we are today. So if for long-term investors, it's a very discounted market, but then again, before you realize that kind of value, a lot of things can happen in between. So risk management.
15 times PE, I think that's kind of low historically, isn't it?
Very low historically. But it is also a changing macro environment. You have higher policy rates. We've never seen interest rates these levels in a decade. So that also figures into why there is this kind of risk market or equity market devaluation.
You mentioned you're favoring fixed income. So what's the mix in terms of your portfolio?
So if it's a balanced portfolio, a 50-50 portfolio, we're leaning more towards 70-30 even. It's really just good enough clip for income returns that helps us weather the equity exposure that we have. That said, depending on your risk appetite or client's risk appetite, certainly who wouldn't want to be exposed to a 3% market move for the index? And a lot of people missed that move. So that can really certainly spur some momentum, some more buying momentum behind it. And if you're underweight, if you're at call it 30% equities versus a 50% neutral, then you feel like you're missing out. But yes, it's really the big picture. It's considering risk and not just looking at returns. That's really important in this environment.
Yeah, that FOMO is a real market driver, right? Well, looking at the PSEi, actually, it's already trading. It's down by 1/4% so far, negligible. But it's so far mixed. You have financials up, mining and oil up. But the rest are trading lower so far. I wanted to talk about the changes in the PSEi, DMCI and UBP going in, and then RLC and MEG moving out. How do you view these? First, the new inclusions or the returnees to the PSEi in terms of their fundamentals. Are you liking them?
We're not particularly nothing standing out particularly on a fundamental basis for these companies. It's really a technical play. We did expect UBP to be added, and so for our portfolios, we've held overweight positions 4 or 5% before the inclusion. So we're actually looking to shave off some of that exposure, given that the event had already taken place. So on X date, we're likely to adjust and take profits on that. But we're certainly not going underweight or or taking everything off the table. So it's really I think more of a technical technical drivers will be what's going to move the needle for the PSEi and for the underlying companies.
But I wanted to talk about RLC and MEG. So they're moving out of the PSEi, and then again, there's some negative sentiment there because of elevated interest rates and construction costs and whatnot. What's your view on property?
Yeah, we're a little bit more circumspect on property, precisely for the reasons that you mentioned. We do like high quality names that are that have net asset values heavily discounted. So you have the usual big caps, Ayala. So we tend to gravitate more towards the index heavyweights, just because we feel like it's more visible, the quality is better, and we don't want to take unnecessary risks at this juncture.
All right. One more question before we let you go. Again, I asked this earlier in the week. The government, the economic team, very aggressive in selling the Philippines as an investment destination. I was wondering, do you expect any spillover of foreign investor interest into the PSE from all of these efforts with, the president going to Davos and, the economic team over in Europe?
I don't know about causality. I do know there is a lot of interest in the Philippines. Our counterparts and contemporaries in Europe, for example, it is a consensus overweight, just because we've lagged for the whole period post-pandemic. The way the dollar strengthened last year really hammered down on emerging markets. Within the emerging market space, we also lagged. You have the China reopening, which will benefit the Philippines. So a lot of these drivers are certainly giving those who are looking a chance, or they're sniffing out the value, so to speak. Perhaps the kind of marketing that a president is doing and attracting more FDIs is more of a longer term play. Certainly can use that kind of investment into the country, but any short-term movement, I think, may be attributable to other market drivers and less of the selling that's going on by the president.
Yeah, because everybody really wants to know when the foreign money is going to come back into the PSEi. They've been absent for a while now, and clearly that should boost the market and the blue chips and everything. And it would be great to time that, wouldn't it?
I think it's time in the markets and not timing the markets, right? I mean, I say that all the time. But in fact, we have been seeing these foreign flows, albeit hot money, the investor flows, again because of the deep value. The FDIs, that's going to follow. I mean, given the macro fundamentals, I mean, we are challenged on some fronts, the twin deficits and all of that. But I think once the bigger or the shorter term concerns subside somewhat, at least the adjustment is done as far as monetary policy is concerned, and we have and we're managing well the fiscal side, that's going to follow.
All right. Thank you so much for sharing your thoughts this morning, Sandra Araullo, Chief Investment Officer at ATR Asset Management. Good morning.
Thank you. Good morning.